who will join later, we'll just get to catch up. So first of all, welcome and thank you all for joining us this morning. We know it's early, especially for those out in Pacific time zone, but we really appreciate. We intentionally scheduled it for first thing in the morning, thinking that this way we could provide some good content for everybody, and then they could get on with their day. So we hope that works. If anyone has any comments and suggestions about anything, time, frequency, topics, etc., please feel free to reach out to us after the presentation. This is the first of what we hope to be a series. We're planning on doing these quarterly. The next one would be on family trusts issues and trust issues generally in funds. So stay tuned for invitations and on that next one in this series. We are offering CLE and CPE credit for this seminar. So if you would like, in particular, the CPE credit, during the presentation, there will be polling questions. You'll need to respond to those. It does keep a record, and then you'll need to complete the evaluation form, and then we can get you the CPE certificate. So just keep your eye out for those polling questions. Today you have myself, Adam Cohen. We'll also hear from Chris Myers and Ryan Nichols. This is just part of our fun team. We're, as I said, we're hoping to make this a series, and so we're divide and conquering. So you'll probably hear from different folks from our fund group at the next session. So let's get rolling on the substance of our presentation. Actually, one thought before I do get started. If you have any questions that you'd like to ask about the presentation this morning, there is the chat feature and the Q&A feature, and you can put your questions in there. We'll try and address them as they come in. If not, we'll try and reach out after the presentation. Okay, so what are we talking about today? We're talking about carried interest. Well, what is that? Carried interest is a concept that in the tax world, the IRS has defined as a negative. So they initially defined what a capital interest is. The IRS issued some revenue procedures in the 93 and then 2001 that addressed what is a capital interest. And a capital interest is one where if you put money or property or something into a partnership and you're entitled to get something back when the partnership liquidates at that same date. So if you're entitled to something immediately upon receipt, that means you have a capital interest. A profits interest, as I mentioned, it's a negative, so it's no right to receive liquidating proceeds as of the date of issuance, meaning that if you sold all the assets or whatever was contributed, if you sold everything at the time of issuance, at the time you get that profits interest, would you be entitled to anything? The answer is no, you're not. You're only entitled to a contractual share of things in the future. And in particular, if it's in exchange for services performed to or for the benefit of that partnership that's issuing the profits interest, then you have a valid profits interest under the IRS rules. And that's basically what the carried interest concept is based on. It's this idea that I perform services, and for that, I get a share of what's going to happen in this partnership going forward, even though I don't contribute capital. I'm being carried by somebody else's capital. That's the carry concept. Some people refer to the carry as the promote. So you sometimes hear that. It's essentially interchangeable of a concept. So If you hear either concept, that's what we're talking about. Where did this carried interest come from? Well, back in the early speculating days of oil and gas, there was, and even on today, people are promoted or carried. And so they might pay a quarter of the costs of drilling the well, and they'll get a third of the proceeds from the well. And so they're being carried because they only they're contributing disproportionately. You'd say, well, wait, now they did contribute. Adam, didn't you just say they can't contribute? The issue is that they are getting more. They're getting more for their money than the other people. So they're relying on the other people's money. And generally, they're getting that. Why? Because they're contributing services. They're the driller, they're the geologist, whatever it is. There was one of my favorite cases in this area. It was from 1974, and it was a horse racing case where the owner of the horse gave the jockey a part of the winnings. And the tax court said, well, there was no partnership. And so the jockey was given a piece of the horse, not literally, obviously, but a piece of the horse. And that was a deemed sale of that portion of the horse to the jockey. So what that case tells us is it's really important that there be a partnership in existence at the time of the issuance, so that you don't fall under the ruling in that case. Taking it all the way to today, you often hear, in particular on the Democrat side of the aisle, people describing carried interest as a loophole. There's this issue, perennial issue of the capital gains rates and what should be entitled to the capital gains rates. And this is for services. And some people view that as saying, well, gosh, if the secretary has to pay ordinary rates for the money he gets from services, shouldn't the managing director of the firm who gets a carried interest have to do that as well? That's a policy issue. I won't get into the views on that, but we will talk about that a little bit more later on. So why in a fund, if you're investing in a fund, why should you as a limited partner be willing to let somebody get a carry? Right? Why not just pay them a management fee? Right? They're just managing your money. If you give it to many investment advisors, you just pay 1% of NAV and you move on. The reason here is both alignment of interest and incentive to incentivize performance. So how does it do that? Well, on the incentivizing performance, because you're getting a share of the actual returns, the actual profits of the venture, the bigger the profits, the bigger your compensation. That's true of a 1% NAV, but it's much diminished, right? It's as NAV grows, yes, their fee will get bigger, but with say a 20% carry, for every dollar they bring in, they get 20 cents. And that's a huge driver to incentivize performance. Alignment of interest is that some GPs will have to put some capital in, akin to the oil patch, third for a quarter. But even if they don't, at some point along the way, there will be a capital share that is subject to loss. And whether there's alignment on the downside, there will be alignment on the upside because of the same reasons that incentivize performance. So with that, I will start the first polling question. So here the question is, what's your familiarity with carried interest? And I would suggest that you answer that without regard to the 10 minutes that I've been talking. So before this presentation, what was your familiarity with carried interest? I'll give you 30 seconds to answer that, and then we'll move on. Great. I'm going to pass it over to Ryan to pick up from there.
Thanks, Adam, and good morning, everyone. Thank you all for joining us. I want to just start with talking about the structure of the promote and the economics of the funds in which you may be investing. What's really important to note is it would take us hours and hours and hours to try to cover every scenario of Waterfall's promote, preferred hurdle, or preferred return and hurdles and things like that. And your question coming into this may be, why do we need an hour to talk about some tax implications of carried interest and a percentage, whether it's 20 or 30? But actually, there's a number of items to negotiate that are going to affect the waterfall and the fund economics and inform how quickly the GP is going to receive its carried interest. Now, one of the least of all is the actual percentage. So some of these concepts, which I'll list now and will be addressed later in the presentation, include the type of distribution waterfall, whether or not there is a preferred return or hurdle, the amount and nature of the preferred return. So for example, the frequency of compounding, how many hurdles exist, the order of the waterfall, whether the GP will have a catch-up following the distribution of any preferred amount to the limited partners, and the treatment of current income or short-term investment proceeds versus realized investment proceeds. So I just rattled off a whole host of things, and some of them we'll cover in this. And as Adam mentioned before, if you have follow-up questions, we can address those at the end or separately after the presentation. Now, who wins on these points is going to depend on a number of things, and each individual item is highly negotiated. And whether it's the type of fund, the investment strategy of the fund, the relative bargaining strength of the limited partner to the GP's interest and desire to close versus the LP's desire to receive an allocation, for example, in an oversubscribed fund. The history and success of the GP and sponsor will have a lot to say about how favorable the GP terms are. The prevailing market conditions and trends are important. The desire for sponsor principals to take profit early, which may depend on the ability to defer receipt. So in other words, if a sponsor principal has the financial independence to sit for a few years, that will, without receiving carry, that may affect the structure. Another component of the negotiations is, what are the anticipated returns? So I'm going to spend most of my time talking about different waterfall types. Now, the distribution provisions of the LPA, which are commonly referred to as the waterfall, include or influence many of the primary economic components of a fund outside of the management fee. And the reason it's called a waterfall is because it's sorted into tiers, and as one fills up, it overflows and you move on to the next. Although you will not see the term waterfall appear in the agreement itself, that is how it is most commonly referred. So I'm going to walk through 3 different types, and then we're going to see some very basic samples to illustrate exactly what we're talking about here. I think the overarching theme, before I get into the individual types, the overarching theme and the common element is that limited partners contributing capital are going to receive their return of capital first. And then what happens after that is informed by the negotiations that we were discussing previously. So the first waterfall type that we're going to discuss is either referred to a deal-by-deal waterfall or an American waterfall. And what I'll say is this is more GP favorable, because the GP is going to start to receive its carry with respect to an investment once that specific investment becomes profitable. So for instance, only once the LP has received its carry and maybe an additional hurdle amount from that investment, will the GP then be able to take an interest in the profit? The reason that this structure is advantageous to the sponsor, I use sponsor and GP interchangeably, so forgive me for that, is because the GP is going to get paid earlier. And it's going to get paid on successful deals, even when another portfolio investment may be sold at a loss. Now, the issue for the limited partners in a pure American waterfall is the GP is not going to receive distributions, or will receive distributions for profitable investments. But then if the fund is suffering losses from bad investments in the future, the LP is not going to be getting the same level of cash back. And the concern, if I can elaborate on that a little more, the concern with the American waterfall is that it may incentivize the general partner to delay the disposition or any write down of a bad investment until later on in the fund and carry that bad investment so it can dispose of the quality investments earlier. Now, having said all of that, I will point out that a pure deal-by-deal distribution waterfall is becoming increasingly more uncommon. And more commonly, what you'll see, if there's an American waterfall, is it'll be modified in order to take into consideration realized losses on deals that are disposed of, or if there are write-ups and write-downs to those investments. And what happens in this sort of modified version is those subsequent deals incurring losses will be taken into account and will ultimately detract from the return that the GP is receiving on future profitable investments. So perhaps to illustrate, perhaps the GP takes carry on an early profitable investment, and then a couple of investments are sold at a loss. Well, if the fourth investment is then profitable, the GP is going to take a hit based on the losses from those other previously disposed of investments. Now, as I said before, the pressure is to move towards a European waterfall or an aggregate waterfall, which I will discuss momentarily. But if you as an LP are in a situation where the GP does have the leverage in order to impose, for lack of a better term, an American style waterfall, there's a number of ways that you can limit the risk as a limited partner to prevent overpayment to the GP. So I don't want to speak on that too much because my colleague Chris is going to spend some time on some of these. But by way of example, that would include a clawback of proceeds received by the GP, an escrow to guarantee the clawback, direct principal guarantees to guarantee the clawback, or as I'll discuss, there's a middle ground which is a different type of waterfall. So I'll talk about that at the end of this slide. The next one, as I mentioned, is called a European waterfall. It was historically all European funds use this, and now this is the direction which a lot of investors are pushing funds. This is more LP favorable. It defers distributions until the back end. And you may also hear this referred to as a back end loaded carry arrangement, aggregate, deal, waterfall, etc. The idea here is that the GP is not going to receive any carry until once all capital contributions and any hurdle amount are returned or distributed to the limited partners. And that's without regard to from which investment that those amounts originated. Now, this is much more LP favorable than the American style waterfall, and there's some specific benefits to the limited partner that you will see include mitigation of accidental overpayment of carry to the GP, which the LP doesn't have the benefit of receiving up front, and which ultimately may need to be clawed back later from the general partner. By having a European style waterfall, there's less time and money that needs to be spent on the valuation of individual assets for the purpose of determining clawbacks. Again, kind of working in a vacuum here, but Chris will talk a little bit more about clawbacks in a bit. It reduces the likelihood that the GP will delay the disposition of bad investments. And that's what I talked about earlier, how in American Waterfall, the GP is incentivized to sit on bad investments so it can make a return on the profitable ones. The limited partners are going to receive more funds and their portion of the profits sooner. And as you all know, that allows you to do what you will with your money and avoid any time value of money issues. And lastly, you avoid having to go through the process of allocating fund expenses across various portfolio companies, because those directly affect what is profitable in regards to that investment. Now, lastly, on this very short slide, but one of our longest ones, I'll talk about what is more of a middle ground, something that isn't quite American, isn't quite European waterfall. It starts with an American waterfall base, but it includes a fair value test. So the general partner isn't going to receive any distributions on its carried interest until the total of the prior LP distributions, as well as the LP's share of the current fair value of the investments, is equal to a predetermined target amount. For example, this target amount may be 125% is something that's commonly seen for deals like this. So once the GP distributions plus their share of the fair market value is equal to 125% of the LP aggregate contributions, the GP can start participating in taking carried interest. Now, again, there is a concern about how to prevent overpayment for the GP. This is a concern in a European structure as well, especially where a hurdle is determined annually and not a flat interest rate. So we'll look at clawbacks, look at interim clawbacks and things like that. So again, I will defer to Chris on the discussion of the clawbacks in a bit. Here's a sample waterfall for a simple European distribution. The LPs in the aggregate consider $300. The GP is going to contribute nothing. So it has no capital interest. It will only be receiving its profits interest or carry. 3 investments are made, each for $100. And after X amount of time, investment A is sold for $150. The result under this simple European waterfall is that the limited partners will receive the entire $150. And that is because the LP has not received the full amount of its aggregate contributions. Now, we can contrast this to the simple American waterfall. Again, this doesn't include all the negotiable bells and whistles. The LPs contribute the exact same $300. The GP contributes 0 and has no capital interest, just the profits interest. The same 3 investments are made for $100 each, and investment A is once again sold for $150. The difference is the profitability is determined based on the investment, and therefore the first $100 goes to the limited partners because that is their capital contributed with respect to that investment. After that, $50 is distributed, but it's divided between the general partner and the limited partner. So in this case, the general partner has a 20% carry. So it's taking $10 of that 50 and the limited partners are splitting the remaining 40. So you can see how even though the LPs have only received 100 of their original 300 back, or sorry, 140 of their original 300 back, the GP has already taken 10. And that's the most basic distinguishing element of the American and European waterfall. So I have talked a little bit about hurdles and catch-ups, and I'm going to dive it a little bit more into those right now. So the payment of the promote to the general partner, which is also called a hurdle amount, is behind the return on capital. And this amounts to a profit distribution preference in favor of the limited partner. So profits will be distributed only to the capital interest holders until a certain rate of return, the pref, is returned. Now, this is commonly calculated as an annual percentage as opposed to a simple interest or single dollar amount in order to better align the GP and LP interests. Adam mentioned this before, and it applies in the case of the hurdle as well. Because what you see is the GP is incentivized to get that minimum return to the limited partners prior to taking its share of the profit. Now, the hurdle may take other forms and may be calculated differently. So for example, instead of an annual rate, there may be a multiple. For example, the limited partners may be entitled to a 2x or 3x return on their capital before the GP is permitted to share in the profits with its carry. And it could also be calculated using an internal rate of return, an IRR calculation. There is not any one size fits all solution. As far as the catch-up goes, the catch-up is a disproportionate payment of distributions to the general partner in the tier of the waterfall following the payment of the hurdle amount to the limited partner. And I'll show you a sample waterfall as I did before for including hurdle and catch-up here in a moment. But the catch-up comes after a return of contributions, after a return of a preferred return, and then the GP receives a catch-up. Now, as I said, this is a disproportionate distribution to the GP, which is usually 100%, but can really be anywhere between probably 50 and 100% of the profit, until such time that the general partner has received a percentage of the profits equal to its carried interest percentage, so say 20%, 20% of the total cumulative amounts distributed with respect to the preferred return, so the second tier to the LPs, and under the catch-up provision. And forgive me for throwing all that at you without the sample. Let's advance to that. So in this example, we've included an 8% hurdle, preferred return pref, however you want to characterize it, and a 100% catch-up in favor of the general partner. So the LP contributes the same $300 and the GP contributes nothing. They make the same three investments, A, B, and C, for $100 each. And investment A is once again sold for $150, in this case, after year one. The result is the first $100. Oh, and I should reiterate, this is a simple American waterfall. So it's a deal by deal waterfall. The result is the first $100 will be distributed to the limited partner as a return on capital. The next $8 will be distributed to the limited partner as its hurdle. That's at 8% per annum on its $100 investment. Then we get to the $2 distribution to the GP for its catch-up. Now this, if you think about it, is 20% of the total of that $8 and that $2. That's where we're looking. The GP's catch-up is 20% of the profits. So don't take into account the $100. It's 20% of that $10 in profit in the second two tiers. And then once the GP catches up, it receives a portion of the 40%, which in this case will be $8 to the GP and $32 to the LP. And this last tier represents the 80-20 split. The last item that I will touch on, I can advance the slides, is the difference between current income and realizations. So among the issues that are going to be negotiated in connection with an investment is the treatment of current income and realizations, which may also be referred to as distribution proceeds. And as we note in our slide, realizations often includes distributions of proceeds in connection with refinancings in real estate. So current income, what we're thinking about here is, for example, real estate funds with mature assets that are throwing off leasing revenue, dividend income, or perhaps income from fixed income securities. These may be subject to promote in the same waterfall as distributable proceeds from realizations, or they may have a separate waterfall, in which case they're based on capital and are simply distributed pro rata to capital interest holders or the limited partners. Realizations or proceeds from distribution are virtually always subject to the promote in the fund waterfall. Now, there are some implications if current income is included, and that is the GP is going to get to its carry much faster. So if current income is being accounted for in the same way as realizations, then the LPs will receive their return on capital faster, their pref faster, and the GP will get in to its carry share quicker. So now I'm going to turn it over to Chris, who's going to start off with general partner clawbacks.
Thank you, Ryan. As Ryan mentioned, my name is Chris Myers. I'm a partner in the corporate group, and I sit here in the Las Vegas office. And my guess is because I used to be a securities regulator, I get to talk about the most fun thing for GPs and fund sponsors, which is the clawback. There's also a clawback for limited partners that's often seen in fund agreements. We won't get into that here. We'll focus on the general partner clawback. But for those that are not familiar with a clawback or tangentially heard the term, clawback provisions are a feature in fund agreements that are designed to require the general partner to return excess distributions of carried interest. And what is an excess distribution can vary based on how the clawback is structured. One version of an excess distribution can simply be the general partner took more than 20% of the promote, or whatever the contractual promote or carried interest rate is, generally around 20%. Another way that a GP clawback can be triggered is if the limited partner hasn't received its preferred return. As Ryan showed in the different waterfalls, it's typically return of capital, return on capital, which is the preferred return hurdle, whatever you want to refer to it as, and then we get into distributions to the GP. A clawback that focuses on making sure that the limited partners do in fact receive their preferred return or hurdle amount is what we refer to as a two-tier or double trigger waterfall. In a two-tier two-tier clawback, and the purpose of a two-tier clawback will provide require the general partner to return excess distributions to make sure that the limited partners have in fact received that preferred return, even if the general partner hasn't received more than the contractual rate of carried interest. Another way that a clawback can be triggered is Ryan mentioned the catch-up distributions. Sometimes those are 80-20, sometimes it's 100% to the GP. But if a limited partner doesn't receive its fair share of the catch-up distribution, it's another instance in which the general partner clawback can come into effect. Now, Ryan mentioned 3 different structures of waterfalls, and what those tie into with respect to the general partner clawback is, when do you calculate the clawback? Oftentimes, the general partner clawback is applied at the end of a fund's life, following final liquidation of the fund's assets. And the general partner will sit down and say, okay, here's the profits we had, here's the distributions we made. Did we take more than, in a pure promote clawback, did we take more than 20% of profits? In a 2-tier or double trigger clawback, did we, did the LP get its carried interest or its preferred return, and did we take more than 20% in promote? Obviously, that the two-tier waterfall is more pro limited partner, and often subject to negotiations between limited partners and the general partner in the early stages of fund formation. In addition to the end of life fund clawback, which is most often tied to European waterfalls, and there's also an interim clawback. Interim clawbacks are provisions requiring periodic hypothetical clawback calculations, assuming the portfolio is liquidated for its fair market value, or some folks say it's an NAV test or net asset value test, and requires the GP to return excess distributions measured at those various periods in time. When those periods in times are subject to negotiation, they can be at the end of the investment period, which for folks not super familiar with private funds, the investment period is the period during which the general partner must deploy or call capital from investors and make investments. It's usually 2 to 6 years, depending on the style of fund, private equity or venture, not an issue in hedge funds. But it's, the interim clawbacks will typically be tied to the end of the investment period, the end of the fund term, and then final liquidation. So, 2 or 3 interim clawbacks where the general partner can measure. And the folks will say, well, why do I need an interim clawback? When is it really going to arise? In a European style waterfall, the point is well taken, that the risk is lower, but it's not. It still does exist. The general partner can take too much, particularly in funds that have a preferred return that accrues and is not being paid out to limited partners. One of the real benefits of the interim clawback is it reduces the time periods in which the general partner may be over distributed. And that's important because general partners are employers, or I should say, they have folks that are distributed at the carried interest. Typically, the GP doesn't have employees, but the investment fund that sets up the general partner does, and folks come and go over time. And the more often you're calculating the clawback, the more likely you are, as we get further down and talk about guarantees, to have folks to go after that are more actively involved in the management of the business still. Pushbacks on interim clawbacks are, it can create instances where you force an interim clawback because during year 7 at the end of the investment period, you say, you know what, general partner, you've taken too much based on how the clawback's structured. We need you to pay back. But then when you get to fund liquidation, the general partner is found to not have taken too much and gets their catch up. So that can create some friction with general partners that say, hey, measure me at the end, not in the middle, because we're probably going to wind up where I'm not taking too much. And so again, it's a point of negotiation with general partners, limited partners. Regardless of when the clawback is calculated, interim, liquidation, whenever, if the GP has taken too much based on the type of clawback, it owes money back to limited partners. Now, in calculating what is too much and how much does the GP have to give back, most funds take into account the general or members of the general partner's tax liability. And so the impact of tax on carried interest is important because it really sets up how much the GP, if it overtakes, has to actually give back. The majority of GP clawbacks are capped at total carried interest distribution, less taxes. And those taxes are often calculated using various hypothetical assumptions, including an assumed tax rate and assumptions regarding application of losses and deductions. The rationale for caps on how much a GP has to return net of taxes is, forcing a general partner to return money after taxes it can be a difficult ask of a general partner with respect to its individual members and employees that are getting pieces of the carried interest. To give an example, assume a general partner over the life of a fund receives $100 in carried interest distributions. With an assumed tax rate of 35%, the general partner's clawback obligation would be capped at $65. So even if the fund later does, a clawback calculation and says, hey, your general partner, you're obligated to give back $70 because you took $70 too much. A clawback that has an assumed tax rate of $35 or 35% would cap that return obligation at 65. So the general partner would kind of get out of that $5 extra or overage in clawback obligation. And the theory there is because the GP doesn't have that money. It's been paid to the IRS. However, if you're asking yourself, 35% hypothetical tax rate seems pretty high, and how does an individual member of a GP take into account losses and deductions? It's a very good point, and there's a contingency in the limited partner space that will often push back and say, let's not use hypothetical tax rates, let's use actual tax rates. And the reason here, just the example I gave, if a member of a general partner's actual tax rate is say 30%. In that instance, the clawback obligation would be $70, not 65. And so, there is a limited partner base that in the negotiation process will really focus on not using hypothetical tax rates, using actual tax rates of members of the general partner. And we'll also take it a step further and say not only should you use actual tax rates, but you should also take into account loss forwards and carrybacks, the character of fund income and deductions attributable to state tax payments, ordinary deduction or losses as a result of clawback contributions or related capital account shifts, and a change in taxation between the date of the LPA and the clawback, right? Tax rates change. And here, where limited partners and general partners wind up in this issue again is subject to negotiation. But the Institutional Limited Partners Association, which is a national organization where limited partners kind of come together and talk shop, their recommended best practice is to have this based on actual tax rates, not hypothetical. And hopefully the examples kind of illustrated how the general partner may be able to overtake if they use too high of an assumed tax rate. Now, as Brian gave several examples on the different style waterfalls, and so what we get into here is where is the when is a clawback actually going to come into issue? Quite often, the fund sponsors will say, well, I've never had to do a clawback. It's low risk, just have it at the end. But and so when folks say, is this really a risk? There's several different ways this can arise. Early gains, late losses. American style waterfalls are, an area where you may see this. And again, to give a hypothetical example here, imagine a fund that makes 3 investments for $100 each. It sells that first investment for $500, and so it has a $400 profit, assuming taking out things like expenses and all that. It has a $400 profit that'll be split 80-20, 80% to the limited partners, 20% to the general partner. So that's $320 to the limited partners, $80 to the general partner. If the other 2 investments are totally written off, and so there's a total loss, now the fund is in a situation where its net profit has been reduced by those 2 losses, and now the general partner has overtaken and owes money back through the clawback. And so that's an instance where an interim clawback could help capture that earlier on in the process, again, either end of investment period, end of term, sometime before the liquidation period. And the other instance where these can pop up is the preferred return is accruing and not being paid. And that goes into, clawbacks that are structured as a two-tier or double trigger clawback, where the clawback is focused on making sure not only does the GP not take more than its allocated portion of the carry, again, usually 20%, but also making sure that limited partners have received their preferred return. So methods of ensuring return of distributions by the general partner. Now, I look at this space as there are methods that you can do upfront that are either sort of de facto or actual ways to help mitigate the clawback issue. And then there's sort of post-life, hey, you owe me money back, things to do to try and make sure you can collect on that clawback. So upfront methods are, one way in particular, which is an internal function of the general partner, which the general partner is usually structured as a limited liability company, sometimes a limited partnership. But they make grants to key contributors, key employees, investment professionals, staff level folks. And so one thing, much like a startup, one thing to try and make sure a GP puts into place is a vesting schedule over its grants of equity in the GP. Vesting, much like seen in startups, the thought process is if you haven't earned it, you shouldn't take it. What earning is varies dramatically across different fund sponsors, but typically or oftentimes carry or the vesting schedule is tied to the investment period, which again I mentioned is 2 to 6 years. And the thought process there is just to make sure folks are contributing during the investment period and not leaving too early, and taking the carried interest with them. Another item is escrow accounts, and escrow accounts were more common in times of old and are becoming less common now. But an escrow, basically just the general partner, limited partners say, hey, a portion of carried interest distributions need to be put into an escrow account until you hit certain thresholds. And the theory there is it's easier to take what's in an escrow account than to chase a general partner for a clawback obligation. And to that point, clawback are typically or should be or recommended to be backed by guarantees. And guarantees can be at an entity level. If you have an institutional fund sponsor that says, listen, we're good for it. But oftentimes for smaller funds, or sometimes even big funds, it is advisable to have the clawback personally guaranteed by the actual recipients of the underlying carried interest. And the thought here is if you get it and you're not entitled to it, we got to make sure we get it back. And the best source for that is often the person that received it. Folks will say, well, I want to house the carried interest in an LLC, and kind of think it's a liability blocker. And so oftentimes, again, it's best to try and get those guarantees personally guaranteed by the actual recipient. Guarantees can be several just to the recipient. They can be joint, everybody's liable, or joint and several, you can go after one person. This is often a risk analysis that limited partners undertake based on the size of the fund sponsor. If you're really early on and a fund is pretty new and the management team is relatively junior and they're sort of just coming out of the gates, this is guaranteeing the clawback or finding security for it becomes more of an issue relative to a more seasoned sponsor. And so with that, again, like Ryan said, any one of these issues can be a days long presentation, but with that, I'll pass it back to my colleague, Adam.
Great, thank you. We're gonna start first with our next polling question. Remember, you need to answer these to be able to claim your CPE. And so the question here is, from your perspective, what's the best way to ensure that the GP is not getting too much? Clawback at the end, interim clawbacks like Chris discussed, escrows, or protections up front? Okay, and while you guys are answering that, I will go on with our materials. Another aspect of carried interest that LPs need to be familiar with is tax distributions. Just like the discussion in the clawback, where the clawback amount is often reduced by the taxes that the GP has to pay on its carry. The GP is also concerned, as the fund is operating, with having upfront tax liabilities. And in particular, say in a European waterfall where they have to wait till all the capital is returned before they see a dollar, they're going to be worried that they get allocated income, their portion of the carry, before they're entitled to those dollars. And so that really drives these tax distributions to be included. And that's why they're so common. Pretty much every fund will have it. The question will become whether that tax distribution is a shared one, whether all partners will get a piece of that tax distribution, or is it only the GP that's entitled to it? More and more we see GPs only entitled to the tax distribution, the argument being, well, they're the ones who really need it. On the other hand, from the LP perspective, where the LP has some negotiation strength, the LP might say, well, yes, we'll make sure you're sharing in the first dollar distributions to get the tax paid, but because that essentially makes it a priority distribution, all partners are going to share. And where all partners share, typically, just like in the clawback scenario, where you have assumptions set out about what the taxes are going to be, there will be assumptions here. And so LPs don't typically want to share their personal tax situation. They don't want to share their tax returns. And so those assumptions become very important. What tax rate is going to be used? Even for a tax exempt that might not be getting any UBTI, unrelated business taxable income, they may get a share based on this assumed rate. And the idea being, look, we don't want to have to get into particular tax situations. It is a priority distribution. Everyone's going to share. But because we see more of these tax distributions being GP only, it becomes even more important how this tax distribution impacts GP distribution. Almost universally, the tax distribution will be treated as an advance, effectively an interest-free loan. It's not actually a loan, but it's treated as that, so that down the road, when the GP becomes entitled to actual cash distributions, whatever they took off the table as tax distributions, reduce those GP distributions. That is the effect of mitigating the impact of whatever assumptions were used. Right? If they assumed the tax rate was the maximum tax rate, and perhaps that wasn't the actual tax they paid, well, it has that impact of reducing future distributions when they were going to be entitled to those dollars anyway. The tax distribution calculation often will also be tied in. Usually the tax rate will be the same as in the clawback tax amount calculation. So another issue that has come about more recently is this new 3-year rule from the tax code section 1061. There are a lot of intricacies of this, and we could talk about this for quite a bit about what the important contours are. There's two aspects that are important to LPs. One is that it creates a 3-year holding period instead of the normal capital gains 1-year holding period. For if this rule applies, you have to hit 3 years in order for the GP and its owners to get capital gains rates. So that creates this potential disparity between LPs and GPs. Also, there's an exception for GP invested capital. And that's important because it becomes relevant for how GPs might ask LPs to fund so that the GP might have invested capital and avoid this rule. So what is that 3-year rule? What has that resulted in? It's resulted in more carry waivers. More funds have these provisions that say, okay, well, I might be entitled as the GP to a carry, but I'm going to be able to waive that carry. And why would the GP want to waive a carry that it's entitled to? Well, because what if that initial carry is because they had an investment opportunity to sell, and it was going to generate carry, but it was within that 1 to 3 year time frame. Well, the GP might say, look, I can waive my carry, I can get the LP's capital, but I don't want to share in that because it's going to be short-term capital gain under that 1061 rule because it's less than 3 years. And I'll take a bigger carry, more than my negotiated percentage, in a future deal. The GP has to take a risk that there might not be a future deal with that return, that they can catch up to their waived carry, but they would do that so that they can get the lower tax rate. From an LP perspective, that would normally, you'd say, that's great. I don't have, I'm going to get a bigger share of that earlier pop. The problems that can hit the LPs there is timing, right? You may be getting more income, but you're also having to pay tax on that. There can be character issues. It may be long-term capital gain to the LPs. It may be short-term capital gain. What if it hasn't even hit a year? What if I'm a tax exempt and that LP gain that I'm going to get out of that first is more UBTI than the future distribution? So you have to be cognizant. What if I'm a foreign investor? You have to be cognizant of those character issues that the GP may be giving you earlier gains, but gains perhaps that you don't want. So something to be cognizant of and negotiate. So we now have our third polling question. And again, I want to get you guys your CPE, so please take a second to answer this, but I'm going to keep going because we're very close to our hour. Where is carried interest going? As I mentioned, there's a lot of talk about carried interest being a loophole. And so there's a variety of proposals out there. Unfortunately, we're running short on time, so I'm not going to talk too much about what these various proposals are. But 10 years ago, there was a Congressman Levin who proposed a new provision that was different than 1061, more stringent, applied self-employment tax to it. And so keep your eye out as people look around for pay-fors. I'm going to skip this, but this is loans could be used to get the GP some capital to make the investment. Very tricky to do. Other considerations, I'm just going to go ahead and talk about that, Chris, just because we're at the end. There are considerations that the GP has to worry about more than the LPs, so that's why we didn't want to talk about it too much. But suffice it to say that when you see representations in the subscription agreement about are you a qualified client, it's because of this issue that the GP really has to worry about more than the LPs. So hopefully everyone had a chance to enjoy the presentation. If you have questions and you want to follow up with any of the three of us, we'd be more than happy to take your questions. Like I said, this is only 3 of our fund group. We are planning another session in about 3 months that will be presented by others dealing with trust issues. And so if you would like to join us, we hope you will. If you have anyone that you know of that may or may not have been part of the invite list for this presentation and want to send us those folks because they might be interested, we'd be delighted to add them and let them participate. So I know I talked fast there at the end to get us to the end, and want to be respectful of everyone's time. So thank you again for joining us. Thank you, Chris and Ryan, for presenting with me. And we look forward to the next presentation and having you there as well.
Thank you very much.